Hello viewers, welcome to the Proven Trading Strategies. Myself Brijesh Bhatia. Well, in the seventh video, if you remember, we have discussed Wyckoff accumulation, how fund manager buy the winning stocks. In this video, we will be discussing on how to detect anomaly in stock price before anyone. In simple term, it means that when the smart player or smart investors, FIIs, DIIs exit their positions, how can you benefit from that and exit along with them before the price takes a big downside? So, in this video, I'll be discussing a distribution phase of Wyckoff theory. And similarly, how do we discuss accumulation phase? It's opposite to the accumulation in the distribution phase. And as it is defined by Richard Wyckoff, and it is an oldest theory. Just a slight background about Richard Wyckoff. He used to write in Wall Street Journal long time ago, and the theory was defined that most of the fund managers or what most of the smart investors exit and retailers don't get to know. So they can use these phases and understand that how the fund managers are exiting their positions or accumulating the positions. Okay. The smart approach to exit this position without affecting the price is very important, and that's what the smart investor or FII DAIs do. So let's look at how the theory plays out. So in the accumulation phase, we saw that preliminary selling happens. In this, after a rally, there are retracements, and at the retracement, when you see a huge volume slightly picking up, which is generally known as preliminary selling in the distribution phase. Then comes the buying climax where everyone wants to accumulate the stocks. And here, the fear of missing out, which we generally known as FOMO, is very high in the buying climax phase. And you see the huge volumes over here. Stocks goes into consolidation for weeks, for months. It makes higher highs, traps the buyer back to the downside, hitting their stop losses, which is generally known as upthrust. And in upthrust, generally the more maximum volumes happen due to the stop losses. And when the buying happens, when the prices hit higher highs, fund managers slow and steady distribute their stock, which means they exit from their existing positions. They do it slow and steady because they don't want to hamper their prices. Anyone, even if you are there, if you get an opportunity to sell a stock at 100, and you will look for 100 rather than going exiting at 90 to 93. So same happens with fund manager as well, because everyone wants the maximum profits or maximum returns out of their trades. Then there comes a more higher high, which is generally known as fake out, and this is the maximum volumes where the fund manager or smart investor exits their position, because that's the highest level. The average automatically comes higher of their selling positions, and this happens with most of the trap. As we, if you remember, in accumulation phase where we discuss shakeout or spring, where prices go down and there is a V-shaped recovery with the volumes. Here too, in the fake out, you see the volumes slightly on a higher side, and when you see volumes on slightly on a higher side and prices not going higher, if you remember, we discussed the volume analysis in our one of the video. Similarly, if the prices are not going higher with the huge volumes, which means that there is a huge distribution has happened. We see a downtick, we see an again uptick, which means that most of the traders or investors feel that prices have retraced and it is going to heading the new high. No, it tests those levels, which is generally known as LPSY, last point of supply. This generally happens with gaps maximum time, where we witness gap down, retest of gaps, and prices go down again, and again the selling pressure continues. And generally, this distribution happens, and stock price forms major top over here. And there can be top for weeks to come, months to come, and even years to come. Let's look at the example. I have taken a slightly older example due to the SEBI rules where we can't discuss the real-time trades. So I have taken a stock view which is slightly older. So look at the Adani ports here. Prices breaking out, made a buying climax. Higher high was formed which is known as upthrust. Again price retraced. Again we saw a fake out happening, and then you look at that downtrend, last point of supply, and we can, if you look at the stock right from around 350, 360 back to the level of 200, and I guess the low was somewhere around 165, 1870 around. So look at the stock was nearly 50% down from the higher levels. In general, this distribution, and look at the volumes at the fake out. You see a huge volume spike over there, and even the prices are not going to cross that highs of that volume bar, which is a first sign of distribution, huge distribution happening, and you should be alert over here. Look at the second example, Maruti, and again this is a slightly older chart. Okay, if you look at the Maruti, we saw a huge rally, buying climax happening, PSY preliminary selling happened. We witnessed buying climax happening, we witnessed fake out happening, and look at the volumes again at fake out. So always, as I said, in the accumulation, the highest volume is in spring. In distribution, the highest volume is in the fake out. So always remember, when that volume bar highs are not taken out consistently, which means that it is a sign of huge distribution happening, and that's, you should be alert on longs over here or buying side over here. So, and if you look at again the Maruti right from around 4800, 4750, 4800 back to the levels of around 3200. So look at the downside it has shown us. So this, the way you can identify the distribution happening, and you can be with the fund managers who are distributing. Well, coming on to the strength, identifying the distribution at major sell off, again and early indications that you are exiting your positions. Fund managers use this system distribution so that they can sell most of their holding at higher prices, and that doesn't affect their selling price. As I said, it is good. Everyone wants to sell their uh, selling price should be higher to make the maximum profits and returns. For derivatives, those who are doing short futures and options, they can look for a good risk reward short trade over here, and this is very very important from a shorter point of view, because you get a smaller risk versus the higher returns on the downside. And always, if you look at the law of gravity, fall are always faster than rise. We have always seen a bearish momentum faster than, so even if you take a 10 days to fall, the rise is always a weeks, months, and even years. With the strength, there are some of the weakness. Analyzing it takes it is very time consuming, and you need to be patient with how the distribution is panning out. Is it the real distribution or no? So you have to keep a watch, and it is time consuming. Sometimes an incorrect reading can lead to the continuation rally, which means that you missed the rally on the upside. As, and this is third point is very very important, you are trading against the crowd. So I would suggest always use the stop losses, and when you're trading against the crowd, because sometimes it happens that you are holding on to the shorts, prices are not correcting, and it again breaks out. So you need to have stop loss in mind before going on the short. And as I said, the highs are always a stop loss, so you need to keep that in your system. Just to summarize, this theory is very very important when you want to look for a strong reversal trader and you are ahead of crowd. So with the smart investors, retailers can also be the smart investors. With the theory of accumulation and distribution of Wyckoff, this theory really helps you out. Fund managers use them wisely to exit their positions without affecting their selling price, and it can be implemented on any asset class which has the volume data. So volumes here plays a key role you need to keep in mind. So that's all in the Wyckoff distribution. In the next video, we will be discussing the most reliable way to identify the big trends. Who is an outperformer, who is an underperformer? You need to keep a watch when you want to take a bigger trend. So I'll be showing some of the examples as well on how to catch that big trends and how it has panned out when I have identified those trends. Signing off, Brijesh Bhatia, and do not forget to like and subscribe to our YouTube channel. And in case these videos are really helping you, do comment on the comment section below. Thank you.
I am delighted that you joined me to learn about my proven trading setups. If you would like to hear more from me, then sign up for the Fast Profits Daily, our free email newsletters. You can click here to sign up. Thank you.